Do terms like stop loss, take profit, or Pip Value leave you scratching your head? Ever found yourself confused by terms like Pip and Pipette? What exactly are they, and how do they affect your trades? Hi friends, welcome to part 2 of our lesson, Essential Trading Terminologies. Today, we're here to answer all your questions and equip you with the knowledge you need to thrive in the Forex market. So let's get started. Stop loss. In Forex trading, one essential tool you need to know about is the stop loss. Let's dive into what it is and why it's crucial. A stop loss is an order that you place to limit potential losses on a trade. It acts as your safety net, automatically closing your position when the market moves against you, preventing further losses. Imagine you're trading the Euro-USD currency pair, and you decide to buy one standard lot at a price of 1.08500. You anticipate the euro will strengthen, but the market can be unpredictable. To protect your capital, you set a stop loss at 1.08450 as your selling price. If the market starts moving against you and the price drops to 1.08450, your trade will automatically be closed, thus preventing further loss. If you think you're in control of your Forex trading, just remember that setting a stop loss is like putting a do not disturb sign on a hurricane. It might make you feel better, but nature will do what it wants. It's just a joke. If used wisely, stop loss can be a savior. Take profit. Now let's move to another important trading term, take profit. This tool can help you secure your gains in the market. Take profit is an order you set to automatically close your trade when it reaches a specific profit level. It's like locking in your gains to ensure you don't miss out on a profitable opportunity. Let's say you're trading the Great British Pound US dollar currency pair, and you decide to buy one standard lot at a price of 1.08500. You believe the pound will strengthen, but you also want to secure your profits. To do that, you decide to set a take profit order at 1.08600 as your selling price. This means that if the price reaches 1.08600, your trade will automatically close and you'll realize a profit. They say in Forex, taking profit is the dessert after a successful trade. Well, who doesn't love a little extra sweetness in their life? Trailing stop loss. Well, this is going to be a game changer for you. Trailing stop loss. This tool adds a dynamic dimension to risk management and profit protection. A trailing stop loss is a special type of stop order that moves with your winning position. It allows you to secure your profits while giving your trade room to grow. When the price of a trading instrument with a trailing stop decreases, the trailing stop loss remains at the same level, functioning as a normal stop out. When the price of a trading instrument with a trailing stop increases, it raises the trailing stop along with it. If the price stops rising, the new stop loss price remains at the level it was raised to, thus automatically protecting a trader's downside while locking in profits as the price reaches a new level. Take note, the mentioned example is true for the buy trade. The limits will be the opposite for a sell trade. Pip and Pipette. Now let's get down to the nitty-gritty of Forex trading by diving into pips and pipettes. These tiny units play a significant role in price movements. A pip is the smallest price movement in most currency pairs, typically measured as the 4th decimal place. For example, if the Euro-USD price moves from 1.0850 to 1.0851, that's a 1 pip movement. A pipette is an even smaller unit, measured as the 5th decimal place. So if the same Euro-USD price moves from 1.08501 to 1.08502, it's a 1 pipette movement. Let's put this into perspective. You are trading the Australian dollar US dollar currency pair, and the current price is 0.7000. If it moves to 0.7001, that's a 1 pip movement. However, if it jumps to 0.70001, it's a 1 pipette movement. These may seem tiny, but they matter a lot in Forex trading, especially when you're tracking profits and losses, and when you're determining the precision of your entries and exits. Pip and Pipette went on a romantic date in the Forex market. Pip said, "You complete me." And Pipette replied, "Well, you're the only one who can fill my Pip spread." Well, let's move on to the next term, Pip Value. Pip value represents the monetary value of a single pip in your trading. It varies depending on the size of your position and the specific currency pair you're trading. To calculate the value of a pip, we use a simple formula. Take 1 pip, which is typically 0.0001, and multiply it by both the lot size and the contract size. In Forex, standard lots consist of 100,000 units of the base currency. Mini lots are 10,000 units, and micro lots are 1,000 units. Let's bring this to life with an example using the Euro-USD currency pair. For a standard lot, 1 pip movement will be equal to $10. Why? Because the price is already in US dollar. So, for every 1 lot placed in Euro-USD, every pip movement in favor of your trade means a $10 profit, like money in your pocket. But conversely, every pip movement that goes against your trade results in a $10 loss. Support and resistance level. Understanding this will help you make informed decisions. Support and resistance are price levels at which traders expect significant buying or selling interest to emerge. They act as psychological and technical barriers in the market. Let's consider the Euro-USD currency pair trading at 1.08500/1.08502. You've been monitoring its price movements and you notice a pattern. The price has been bouncing between 2 specific price levels, 1.08400, support, and 1.08600, resistance. Support at 1.08400 represents a level where buyers are willing to step in and prevent the price from falling further. This could be due to various factors like historical significance, a round number, or strong demand. Resistance at 1.08600, on the other hand, is a level where sellers tend to enter the market, preventing the price from rising. Again, it could be due to factors like a psychological barrier or historical importance. Now, here's how you can use these levels. If the price approaches 1.08400 and bounces back up, you might consider a buy trade, expecting support to hold. If it nears 1.08600 and starts to drop, you might consider a sell trade, betting on resistance. Question time, guys. What did the trader say to the support and resistance levels at the end of a tough day? You guys are always there for me, even when the market isn't. Thanks for the emotional support. Now let's explore how bullish and bearish sentiments apply to the Forex market. In the Forex market, being bullish means having a positive outlook on a currency pair's future price movement. It's the belief that the base currency will strengthen relative to the quote currency. Conversely, bearish in the Forex market implies a negative outlook. Traders expect the base currency to weaken compared to the quote currency, leading to a downward price movement. Liquidity. Next up, let's dive into liquidity, a fundamental concept in trading that influences how easily and quickly you can buy or sell a trading instrument. Liquidity refers to the ease with which a trading instrument can be bought or sold in the market without causing a significant change in its price. Highly liquid trading instruments can be traded quickly, while less liquid trading instruments may have slower trade execution. Imagine you're trading the Euro-USD currency pair. It's one of the most traded and highly liquid pairs in the Forex market. Traders worldwide are actively buying and selling this currency pair. Because of its high liquidity, you can enter or exit positions in the Euro-USD pair quickly without significantly impacting the price. The spread between the buying and selling prices is typically narrow. Now contrast this with a less liquid trading instrument, such as the US dollar Czech koruna. The spread on this instrument is much wider due to its low levels of liquidity. Volatility. Now moving on to volatility. Volatility refers to the magnitude of price movements in the market. High volatility means prices change rapidly, offering the potential for profit, but also increased risk. Low volatility implies steadier prices with less profit potential. Let's consider the cryptocurrency market, known for its high volatility. Suppose you're trading Bitcoin, BTC. Over a short period, the price of one Bitcoin can experience significant fluctuations. For example, in just a few hours, Bitcoin's price may surge by 10% due to positive news or sentiment. This rapid rise is an illustration of high volatility. Conversely, it can also drop by 10% or more within the same time frame, displaying the downside of volatility. Now let's contrast this with a stable government bond, known for its low volatility. Over the same period, the price of a government bond may change by only a fraction of a percentage point, reflecting minimal price movements. Traders often seek out high volatility for potential profit opportunities, but must also be prepared for increased risk. On the other hand, low volatile instruments are favored by those looking for stability and consistency. Hedging. I hope you're awake so far. Well, moving on to hedging. It's a risk management strategy. It involves opening two opposing positions to offset potential losses. For instance, if you are long on one currency pair, you can hedge by going short on the same pair for the same trading value to protect your capital. Let's say you're holding a long position in the Euro-USD currency pair because you expect the euro to strengthen. However, you are concerned about potential market uncertainty. To hedge your position, you might simultaneously open a short position in the Euro-USD. This way, if the Euro-USD long trade incurs losses, your short trade of Euro-USD can potentially offset those losses. If I had $1 for every time I heard someone explain Forex hedging, I'd probably be financially stable enough not to need hedging in the first place. Speculating. Hold on to your hats, we are about to discuss speculating. Speculating is what traders do. It's all about taking calculated risks to profit from market movements. Traders speculate on whether an instrument's price will rise or fall, making trades based on their analysis and market outlook. Consider the oil market. You've been analyzing global events and believe that an upcoming OPEC decision will lead to a surge in oil prices. Based on this speculation, you may decide to buy oil contracts, expecting to profit from the price increase. It's called Forex speculating because you're essentially making educated guesses with your money, and sometimes those guesses are about as educated as a goldfish with a calculator. Scalping. Now let's discuss scalping. Scalping is a short-term trading strategy. Scalpers aim to profit from tiny price movements by making many quick trades. They often hold positions for just a few seconds or minutes, aiming to accumulate small gains over time. Let's say you're scalping the Great British Pound US dollar currency pair. You observe that during a news release, the price tends to experience rapid price fluctuations. You open multiple quick trades, buying and selling within seconds, capitalizing on these brief price movements to accumulate small profits. Forex scalping is the financial equivalent of speed dating, where you're in and out before you even know if it's a match. Slippage. Slippage occurs when your trade is executed at a different price than expected. It typically happens during periods of high volatility, high volume trading, or low liquidity when the market price changes rapidly. Slippage can affect your trading outcomes. Suppose you're trading the stock CFD of a popular tech company during its earnings announcement. Just as you click to execute a buy order at $100, the market's high volatility causes the price to change rapidly, and your order gets filled at $101.50, resulting in slippage. EAs. Up next, we have EAs. EAs, or expert advisors, are automated trading programs that operate within your trading platform. They can execute trades, apply technical indicators, and manage your trades based on preset criteria, making your trading more efficient. Let's say you've developed an EA that uses a specific technical indicator to identify potential entry points in the Euro-USD currency pair. When the indicator's conditions are met, the EA automatically executes buy or sell orders, helping you stay disciplined in your trading strategy. Technical indicators. Now that we've covered EAs, let's move to technical indicators. Technical indicators are tools used to analyze price charts and make informed trading decisions. Common indicators include moving averages, MACD, moving average convergence divergence, and relative strength index, RSI. When analyzing the market, you can use the relative strength index, RSI. If the RSI reading falls below 30, it indicates that the stock is oversold, potentially presenting a buying opportunity. Conversely, an RSI reading above 70 may suggest that it's overbought, signaling a potential sell opportunity. Using technical indicators is like having a treasure map in the world of Forex. They show you where X marks the spot for potential profit, and the buried treasure is a successful trade. Risk management. Lastly, risk management is the foundation of successful trading. They call it risk management because it's like managing a wild circus. You have to make sure no trading lions, tigers, or elephants escape and wreak havoc on your portfolio. Well, that's not the case. It involves strategies to protect your capital, like setting stop loss and take profit orders, calculating position sizes, and diversifying your investments. That's a wrap for part 2 of our Essential Trading Terminologies series. We hope you found these insights valuable in your trading journey. Stay tuned for more informative content, and don't forget to like this video and subscribe to our channel.